Very good morning, and thanks for joining. So, whether my audio and videos are clear, can someone confirm whether audio and video is clear? If audio and video is clear, please type AC. AC stands for all clear, audio, video clear. Very good morning, and thanks for joining. So, if audio and video is clear, please type AC. Can someone confirm whether audio and video is clear? Deepak Pandey, thanks for that confirmation. So our scheduled time is 11 a.m. We'll just wait for 2 or 3 more minutes so that others can also join and settle down. And we have Venkatesh Suryan joining us. Prantik Das, thank you so much. Thanks for the confirmation. Yeah, Venkatesh, whether my audio and video is clear. Naveen Kumar, thanks for the confirmation. We'll start session in another 2 minutes. We'll start it in another 2 minutes. Okay. So today's topic, like every Sunday, we have this particular session where for 60 minutes we'll talk about the basics of credit and financial analysis, and this session will act as a stepping stone for you to get into the world of financial analysis, right? And before we start the session, please introduce yourself, from where you are attending this session. Mention the name of the bank or organization you are working for so that we can have idea of mix of audience we have today. So go ahead, Deepak, Prantik, Naveen Kumar, Venkatesh, and others. Please introduce yourself, from where you are attending this program. Mention the name of the bank or organization you are working for. And this session will span for maximum 60 minutes. And the idea or objective behind this session is to give you that foundational knowledge and to take a decision as to whether you want to learn more deeper in financial analysis. Okay. The time is 11:05. We'll just wait for 1 more minute. We'll start by 11:06. Okay. Just give me a moment. Okay, Deepak from Punjab and Sindh Bank. Okay. Others, please introduce yourself, from where you are attending this program. Mention the name of the bank or organization. We have Prantik Das from Guwahati, working in Bank of Maharashtra, credit officer. Warm welcome. Okay, now the time is 11:06. Without further delay, let's get started. Let me just share my presentation. Yeah, I hope my presentation is clear and visible. I'm also just recording this webinar. Yeah. So the title of this webinar was Financial and Credit Analysis, right? But I also wish to give another title, How to Analyze Financial Condition of Business Without Spending Years of Education on Finance. Yes, because if you want to analyze the financial position or condition of a business, it is not necessary that you should be a chartered accountant or you should be a certified MBA holder in finance, not like that. There are certain key areas which we have to focus on, certain areas which communicates the pulse of the business, and by getting hold of that, you will be able to analyze financial condition of any business. Okay. And the objective or the goal behind this webinar is to help the bank executives and finance executives and professionals to have this foundational knowledge of financial analysis. Why? Bank executives, let's say in their role, either as credit analyst or credit officer or credit manager, or as a relationship manager or branch manager or a sales manager, they are dealing with credit, and credit decisions are based on credit analysis and financial analysis. So in that context, learning financial analysis is very important for them. Similarly, finance executives and finance professionals who are going to be on the opposite side, that is, they are going to approach the bank and financial institutions for getting credit for their organization, and they should know what are the expectations of the lender, let it be bank or financial institution. What are their expectation, how they are looking at their organization, what they see as plus and minus, positive and negative. As a finance executive and professional, if you can understand this, if you can step into the shoes of the lender, then you will be able to raise funds for your organization in a more effective way at less cost without much of hassles. You will know what they are expecting. Okay. So understanding the expectations of the lenders. So that's the objective. So with this backdrop, it's time for us to get started. So are you ready? If yes, please type ready. Please type ready, or you can simply type start. Simply type start. This is basically to ensure our internet connectivity is on. And because for me, it happens now and then, the connection goes off. Okay. Without even being aware of that, I keep talking. Right? Yeah. Gopal Krishnan confirmed. Yes. Venkatesh. What about Naveen? Deepak, Prantik, all of you. If you're ready, please type ready or just type start and we'll go ahead. Right. Before getting into the presentation, let me just take 2 to 3 minutes to introduce myself, because probably you are listening to me for the first time, so you should know whether I have that qualification or capability to talk about this. See, now I'm into this online teaching space for more than 6 years. And in this period, I had opportunity to train thousands of bank executives on domains like credit analysis, financial analysis, working capital, term loan. And for all this, what is my base from where I got knowledge for all this? I would attribute that to my job experience in State Bank of India. I worked in State Bank of India for a period of 4 years. That was from 2008 to 2012. I joined as credit analyst, and in a short period, they elevated me as team leader of credit processing cell. So I was able to handle more than 5,000 crore worth of loan proposals. So that experience gave me that requisite practical and theoretical knowledge to talk about this. And when I joined State Bank, I carried this tag actually, CA Raja, BCom, PGDBA. At the time, it was ACA. So I had that headweight also. But the first 3 to 4 months was a real nightmare for me, because in CA final and all, CA final, we have done so many complex analytical case studies, everything. But when I saw them in reality, it shocked me, because day in and day out we used to get balance sheet, we have to analyze. One day we get for construction, next day it's going to be iron and steel, next day it's going to be textile, each different models. And using all this balance sheet, we have to arrive at ratios, look at their cash flow, fund flow, then we have to arrive at their limits they are asking for, let it be cash credit or overdraft or term loan or LC or BG. And this required thorough analysis, thorough financial analysis. But thank God, I had good mentors in State Bank. They guided me, they encouraged me, and because of their support and guidance, I was able to learn things fast. And in this 4 years, I had handled more than 250 projects. It's 5,000 crore plus size. And after 4 years, I came out and started my CA practice, which spanned for almost 7.5 years, where my extensive focus on project financing, debt syndication, and debt-related consultation. So at the time also, whenever I interacted with bankers, I noticed that the bankers on the other side, they are weak on the technical knowledge here, because financial analysis is a technical skill. They are weak. And the reason is, in banks, how the practice happens, they just put you in a role. They just put you in a role because of transfer, and you have to learn on the job. And by the time you learn the job, you will be transferred to the next department, or you will be posted to the next branch. So this is what happening. And this is not an area where you can afford to make mistake, because here the mistakes will be very costly and it will have very long term effect. So when I worked in State Bank, my juniors used to request me or ask me to teach them on basics of financial analysis. I used to teach them in the evening sessions for a few of my juniors. And when I came out and started my CA practice, I saw this at all bank level, where people are struggling with certain basic financial analysis knowledge level. So to help them, I started teaching. And today, thanks to technology, more than 3 lakh students are learning and financial and credit analysis through my online courses. And my YouTube channel has crossed 1,35,000 plus subscribers. So this is my backdrop. And with this backdrop, let's get into the session. And my question to all of you is, are you really serious about learning financial analysis? Are you really serious about learning financial analysis? If your answer is yes, please type this ISAFA. What is that? I am serious about financial analysis. If you're really serious about learning financial analysis, please type ISAFA, which stands for I am serious about learning financial analysis. Okay, let me see who are all serious about learning financial analysis, because it's Sunday, your holiday, the time you're supposed to spend with your family, friends, recreation, outing, but you have set aside all those and now sitting in front of your mobile or laptop. So you got to be serious. That's why you are sitting now. And let's document it. As Venkatesh is serious, Gopal Krishnan is serious, Sampath is serious, Kushali, serious. Yes. So if you're really serious about learning, because this is the highly coveted skill which you can be really proud of if you're a banker or if you're a finance executive or professional. Okay. Right. With this, let's get into the session. Today's session, we are going to focus on financial analysis, and depending upon the time pattern, I'll try to cover more. Yeah. Vijay Patel is also serious. Good. Let's see now. Now, to take you to the concept, let me start with one basic question. It's a small comparative analysis. I'm going to throw you a question and you have to give your answer without applying your mind. Okay, please don't get into any analysis without applying your mind. You have to say which company is performing better here. Is it company A, which has reported a profit of 10 crore, or company B, which has reported a profit of 5 crore? Which company is performing better? Please just type A or B. Don't do any analysis. I mean, switch off your mind and give me the answer. So Venkatesh is saying it's company A. Sampath is saying company A. Gopal Krishnan is saying it's company B. What about others? Which company is performing better here? Is it company A, which has reported a profit of 10 crore? See, and one more thing, I have not given you any additional information for you to analyze. That's why I said, without thinking, you can switch off your mind and give your answer. Which company is performing better? Is it company A or company B? Yeah, Kushal is also saying it's company A. Obviously, the majority answer will be in favor of A only. Absolutely no harm in that. But if I give you one additional piece of information, that is, the sales achieved by the company A is 100 crore and sales achieved by company B is 25 crore. And if I ask you once again which company is performing better, what will be your answer now? Will it be same A or B? If you're changing your mind, good, record it. Once again, I am asking which company is performing better. Because earlier you took decision only based on raw data, which is profit. But now, along with that raw data, I also gave you an additional information called sales. And now do some analysis, do some comparison, then take a decision. Yes, now I am seeing answers in favor of B. Sampath, Venkatesh, Vijay Patel, Kushali. Navin Kumar says he can't say. Probably he needs more information, further more information. Okay, but with this limited available information, if we have to select, let's say additional information will be available in the later stages. At this point, if you want to compare and take a decision, which one will you say? Obviously, majority answer will be in favor of B, because company B has a profit of how much? Company B has a profit of 20%, whereas company A has a profit of only 10%. So earlier, when I supplied you the raw data, you took the decision without any analysis. But when you did some analysis, you changed your opinion itself. Earlier, you thought A was doing better when it was raw data. But when you had an analytical information, when you analyzed, you concluded that B is actually performing better than A. Why did this happen? Because you related these two parameters, profit and sales, and you arrived at something known as profitability, or we call it as profit margin. See how powerful the analysis is. When you took the decision based on raw data, the probability of failure is high. When you took the decision based on analysis, probability of failure will be low. Are you all with me? When you selected A without doing any analysis, the chances that decision can go wrong is very high, because it was just a random answer without applying mind. Because I said, don't apply your mind and give me the answer. But when I supplied you the additional piece of information, that is sales, and when you compare the profit with sales, you are able to do an analysis, a meaningful analysis, and you are able to take a decision, a meaningful decision, a quality decision. And that's the power of analysis, and that's the power of financial analysis, especially. Okay. So this is the backdrop, and in this pattern only we are going to run this seminar. Okay. So are you finding this pattern cool? If yes, please type cool, C-O-O-L. Or if you find it super cool, you are welcome to type super cool as well. But here, what I did is I just threw a simple example to demonstrate the importance of analysis. Do not take decision based on raw data, do analysis. And when you do an analysis, it should be analysis of comparing the two relatable items. You cannot compare two random items and try to infer something out of it. That will not work out. Okay. Let me give you one more example. Look at this. So there is a company called X Limited. In 2019-20, they had current asset of 100 crore. In 2018-19, they had current asset of 60 crore. So we'll look at this as previous year and current year. Okay, for simplicity purpose. In the previous year, they had current asset of 60 crore. In the current year, they have current asset of 100 crore. And if I ask you, in which year this organization is healthy, which year you will say? Is it 2018-19 or 2019-20? In 2018-19, they had 60 crore current asset. 2019-20, they have 100 crore current asset. And I hope all of you know what is current asset. Current asset are those assets which can be converted into cash within a period of 1 year, right? Any asset which you can convert within a period of 1 year, you can call that asset as current asset. So now tell me, in which year this company is healthy? Is it in 2018-19 or 2019-20? Just type that answer. And again, here also, you can keep your mind off. Okay, mind off, because I'm trying to stress on the importance of analysis. Yeah. So Venkatesh is saying it is in 2019-20, they look healthy because they have current assets of 100 crore. Sampath is also saying it's in 2019-20. What about others? We have many participants. What about others? In which year this entity looks healthy? Is it in 2018-19 or 19-20? Okay, so let me conclude like this. Obviously, most of us will go for 2019-20 because that 100 crore looks more enticing, appealing for us, right? But let me supply you one more piece of information. That is their current liability. In 2018-19, their current liability is 30 crore. And in 2019-20, their current liability is 110 crore. Now, let me ask you once again, in which year this entity is healthy? Is it in 2018-19 or 2019-20? Now give me your answer. In which year this entity is healthy? Is it in 2018-19 or 2019-20? Okay, now we will start seeing U-turns. Because earlier we felt it is in 2019-20 when they had 100 crore, they were healthy, but actually they are healthy in 2018-19. In 2019-20, they are bleeding. Why? Because in 2018-19, when their current liability, that is obligation, which they have to settle within a period of 1 year is 30 crore, to settle that 60 crore, they are healthy. Within 1 year, they have to pay 30, and for paying that, they have 60, they are comfortable. Whereas in 2019-20, within 1 year, they have to pay 110 crore, and for paying that, they have resources of only 100 crore. It means they are facing or they are having a shortage of 10 crore on the face. They have to look out for sources to fill that gap first of all. Then only they can talk about being healthy, because now they are in trouble. So look at here. Here also, when I supplied a raw data and asked you to take a decision, the majority decision was in favor of 2019-20. But that decision, which was taken on the basis of raw data, took a U-turn when you did a small analysis, when you compared the current asset with the current liability. Because when you compare the current asset with the current liability, what you are able to infer is the liquidity position. Liquidity position means ability to meet short-term expenses obligations with the difficulty or without difficulty. In 2018-19, they had more ability to meet their short-term expenses and obligations without difficulty, because they have to pay only 30 crore. They have resources of 60 crore. It means their liquidity position was good. And in 2019-20, within 1 year, they have to pay 110 crore. And for that, they have resources of only 100 crore. So their liquidity position is in a bad shape. And all this is made possible when I did a small analysis. I can take this analysis to the next level without even looking at these numbers, these figures, 60 crore, 30 crore, without even looking at this. Just by using one small ratio, I can come to the same conclusion. How? It is possible by looking at a ratio called current ratio. Do you know how current ratio is calculated? Very simple. Current assets in the numerator, current liability in the denominator. As simple as that. So if I take 60 in the numerator and 30 in the denominator, what I will get? I will get the value as 60 by 30 is equal to 2. And since it is a ratio, I will be writing it as 2:1. And what that means? It means for every 1 rupee which have to be settled within a 1 year period, I have 2 rupees of resources. So it looks satisfactory, right? So without even looking at all these numbers, if someone says current ratio is 2:1, I can infer that the liquidity position of this entity is good. Why? Because within 1 year, they have to pay 1 rupee. And for paying that 1 rupee, they have how much? 2 rupees. So current ratio of 2:1 is good. Liquidity position is good. I need not even look at these numbers. For me, this ratio is enough. So look where we are progressing. We started by taking a decision on the basis of raw data. Then I said, don't take decision based on raw data, do an analysis. Then we analyzed, and out of analysis, we inferred. But we can make it even more simpler by just looking at the ratio. That is, let someone calculate all this. Just give me this figure. Okay, just give me this figure. If that's how your sanctioning authorities are taking decision in banks. You do all the calculation, but sanctioning authority, they will say current ratio 2:1. Okay, good. Current ratio, let's say below 1, say 0.75:1, throw the proposal. They will reject the loan. Why? Because that is going to communicate on the face what is the position of the entity, financial position of the entity. So when I look at the ratio 2:1, I understand that this entity is healthy. But in the next year, 2019-20, if you look at the scenario, already we discussed that liquidity position is bad, and that can also be inferred by looking at their current ratio. Because if I calculate the current ratio, it's going to be 100 crore divided by 110 crore, and the value what I will get is 0.91, and I will write it as 0.91:1. And what does that mean? For paying 1 rupee within a year, they have resources only 91 paise, which they can generate within a year, or they can convert as cash within a period of 1 year. I repeat once again, within 1 year, I have to pay 1 rupee. But for paying 1 rupee, I need resources, right? Where I will look for the resources? Obviously, I have to look for current assets because I cannot sell the land, building, plant and machinery and pay off my current liabilities, right? If I do so, the business will not continue. So what resources I have to look for paying the current liability? If I want to pay current liability, I have to look for current asset only. For paying 110 crore, what I have is only 100 crore. It means for paying 1 rupee, I have only 91 paise. So it is a clear indication that this entity is facing liquidity trouble. So look, raw data to analysis. Analysis will be made more meaningful if you start making use of financial analysis tools. And in that, ratios are powerful tools. And in this example, we actually made use of ratio. When I look at 2:1, I understand the entity is healthy. When I look at 0.91:1, I understand the liquidity position in this entity is in very worrisome stage. They have to do some alternate arrangement to rectify this, to come out of the problem. So how that can happen? They have to bring some long-term funds so that the dependency on current liability will gradually come down and the current ratio will improve. So this is another example to understand the importance of financial analysis. Officially, we have not started the session. I'm just setting the premise for our discussion. Are you finding this discussion useful so far? I think we have spent almost around 25 minutes now. Are you finding this discussion so far useful? If yes, please type IDV. IDV, that stands for I am deriving value. I am deriving value because your every minute counts. Sunday, when you are sitting here, I want to double ensure you are deriving value from the session. Yes, yes, I could see so many IDVs. Thank you so much. Thank you. And now let's formally get into the session. I said we'll talk about financial ratios, then other topics if time permits. So what do we mean by ratios? Ratios are not new for us. Actually, everyone who have completed the schooling, they would have studied ratios. I can vouch for it because my son, who is in grade 7, is studying ratio. He studied ratio in grade 6. He's studying ratio in grade 7 also. Okay. So it is not something new for us. So ratios are basically relationship between two numbers. If you take the current ratio, we related what? Current asset and current liability. If you take profit margin, what we did? We related the sales and profits, right? So ratios are a relationship between two numbers, but that relationship should be logical relationship. When we related current asset and current liability, the logic is we are trying to infer liquidity. When we related the sales and profit, the logic is we are trying to understand the profitability. Like that, there should be some logical premise for relating two numbers. So ratios are relationship between two numbers which are related in a logical way. And if you calculate ratio on this premise, then probably you will be able to measure the performance of a business entity, like how they have performed in their past, present, how they will perform in future. That's why in banks, they give lot of weightage for ratios. They look at profitability ratio, they look at liquidity ratios, they look at debt equity ratio, they calculate something known as DSCR ratio, they calculate return on investments ratios. Why they do all this? They do all this to look at their past, present, and they also do this to understand the future of the business. Apart from that, ratios will also help us to understand what are the strengths and weaknesses of the business entity. Okay, so in this backdrop, let's go deeper into the discussion. So what are the wider classification of ratios? Ratios can be broadly classified into liquidity ratios, capital structure or leverage ratios, activity ratios, and profitability ratios. Okay, first let us talk about liquidity ratios. Let us talk about liquidity ratios. So I'm going to use a memorandum balance sheet. Now just listen. See, in every balance sheet, the liabilities can be divided into two types. Assets can be divided into two types. Liabilities can be divided into short-term liabilities and long-term liabilities. Similarly, assets can be divided into short-term assets and long-term assets. As simple as that, right? Now, if you look at the image on screen, I have marked the short-term liabilities within yellow box and I have marked short-term assets in blue box. And if you look at the size of these boxes, short-term asset is greater than, the size of short-term assets is bigger than the short-term liability size. Intentionally, I have done this because if a business got to be healthy, its asset and liability composition, especially the short-term assets and short-term liability composition, should be like this only. Meaning their short-term assets should be greater than short-term liabilities. Let me give the technical name for short-term assets and short-term liabilities. Current assets and current liabilities. Already we have discussed, right? Current assets and current liabilities. Current assets should be greater than current liability. If that is the scenario, then the liquidity position of that entity will be healthy. On the other side, if short-term assets are going to be lesser than the short-term liability, then that business will get into liquidity-related serious problems. Sometimes the net worth of the business will not come for rescue because some business fundamentally they'll be very strong. Okay, they'll have rich heritage, so many years of presence. Their net worth will be very strong. But if they make a mess around the liquidity, their net worth will not come for rescue because net worth is many times they are intangible in nature. They'll not come for rescue. Reputation, intangible in nature, it may not come for rescue. Liquidity means ability to pay your short-term expenses and obligations without difficulty. I repeat, liquidity means ability to meet your short-term expenses and obligations without difficulty. At the time, we cannot bring net worth for supporting that. So the message is this. We are going to talk about liquidity ratios, and the ideal scenario for any business is their short-term assets should be greater than short-term liabilities. Short-term assets should be greater than short-term liabilities. Now, in this context, I want to explain one important principle with all of you. Okay. So whoever attending this webinar, if you ask me what is your key takeaway from this webinar, I would say it is this principle called fund utilization principle. It's such a powerful principle, so do not miss even a single point. So just now I said a business can raise short-term funds, right? With that, they can create short-term assets. But what I said is short-term assets should be greater than short-term liabilities. Only then they'll be healthy in terms of liquidity. But how that is even possible? Because I raised only this much of short-term liabilities or short-term funds. With this, how can I create more short-term assets? It is possible if I raise some long-term funds also to fill the gap. Because here, if I want to fill this entire short-term assets, I need this yellow short-term liabilities and something from green long-term funds also. So it should be like this. So here, if you notice, I have raised a lot of long-term funds, something I have used for creating short-term assets. It means me balance, I'm using it for creating long-term assets, right? So here, how the principle works is, this principle says, if you're raising short-term funds, you can use it for creating short-term assets. Good. If you're raising long-term funds, you can use it for creating long-term assets. That is also good. If you're raising long-term funds, a portion of it, wherever it is permitted, it can be used for short-term assets also. That is considered as ideal, right? If you are raising long-term funds and investing in short-term assets, you will have peace of mind in running the business. Why? Because this amount need not be paid immediately. It means so this amount can be rotated as many times as per the operating cycle or working capital cycle of your business. And whenever a cycle is completed, it is going to bring cash for the business. So whenever cash comes in, it is going to bring profit also. So that will make that business more healthier. So the principle says short-term funds can be used for short-term purpose. Long-term funds can be used for long-term purpose. Long-term funds, wherever permitted, a portion of it can also be used for short-term purpose. But this principle emphasizes on something very important, that is never, ever use short-term funds for long-term purpose. Never ever use short-term funds for long-term purpose. If you use short-term funds for long-term purpose, it is the path for disaster. Why? Because short-term funds per se, they have to be repaid within a period of 1 year. So you borrowed money with the promise you will repay within 1 year. And if you want to repay that within 1 year, you have to use that money in your business in such a way that money will come back to you within a period of 1 year. And that is possible only when you invest them in short-term assets, right? Let's say I have raised 10 crore short-term funds. I can use it in short-term assets so that this 10 crore will come back to me within a period of 1 year so that I can fulfill my promise of paying the short-term liabilities within a period of 1 year. But instead, if I use short-term funds for creating a long-term asset, let's say I invest that money in purchasing land, building, machinery, or investing in subsidiary, or giving loans and advances to known people, unknown people, all those for a longer period of time, this will put me in trouble because these people have given money only for short-term period, only for 1 year. So exactly on the due date, they will ask for the payment. On the due date, if you're not going to make the payment, they will send you follow-up mails, follow-up calls, follow-up persons, 30 days, 60 days, 90 days. And if it is a bank, on the 90th day, they will classify the account as non-performing asset. And if the loan amount is not recoverable, then that entity will be flagged as NPA in all civil records, all credit records. So that will put an official N card for the business. Because once you become NPA, whatever the securities that was given to the bank, that will be enforced. And you will be labeled, you will be stamped as a defaulter in credit records. And in future, no banker will dare to fund you. No banker will dare to fund you, and you will not be able to raise any funds from banking channel. And that message can even spread across. It can even go to suppliers and other areas where you will not get credit when you deserve. That will put an official N card for growth opportunities of a business, or it can even bring the business crashing down to stop the operations. It happens. Okay. See, actually, Reserve Bank conducted a study to understand why business units are becoming sick, why they are becoming non-performing assets, why they are becoming defaulters. And they noticed there are various reasons like poor sales, high competition, no proper management, or not upgrading to the technology, or getting into the legal issues, HR issues, or macro factors which are beyond the control. But what was very stunning is only 5% of the businesses are failing because of these reasons, whatever I said now. It means remaining 95% of the businesses are failing only because of a single reason called financial discipline. They don't have financial discipline. They don't focus on certain areas. And when I say they don't have financial discipline, predominantly majority of them, they failed, they become NPA, they become defaulter, their business got stopped only because of the single mistake called diverting the short-term funds for long-term purpose. Because they diverted short-term funds, they invested that in long-term purpose. Whoever have given the money, when they asked for the repayment, they were not in a position because that money is not in short-term assets, it is in long-term asset. They tried selling the long-term asset, it is not happening because the classification itself, it's a long-term asset. You cannot sell it just like that. Even if you forcefully sell, it will come at a loss. And what is the impact? The impact is they are not able to fulfill the promise. When they don't fulfill the promise, these guys won't keep quiet. They'll go for legal action. When they go for legal action, then your very business will come down. That's why never ever commit this mistake. And the attendees, the majority of the attendees today are bank executives, finance executives, right? So please spread this message. Please take this principle to the entrepreneurs you know. Just 3 to 5 minutes, you'll be able to explain this principle. Even whenever I get an opportunity to interact with entrepreneurs, I lay high emphasis on this principle because this will act as a savior for them. Not only that entrepreneur, the dependents, the employees, the lenders, various stakeholders, everyone will be taken care if they appreciate this principle and if they do not commit this mistake. So how do you find this principle? Do you find this principle useful? If you find this principle useful, please type useful. Or if you find this principle super powerful, please type super powerful. It's such a powerful principle. It is such a powerful principle, but not really taught. Not everyone is taught about this principle. Not everyone is educated about this principle. And it's because of that mistake, several businesses, people who are working in NPA department of banks, like stressed asset recovery branches, SAMB, we say, stressed asset management branches, or the department that deals with NPS, credit risk management department, they'll know that most of the businesses, they get into that NPA stage not because of macro factors, not because of poor sales, not because of competition, but only because of this mistake of diverting the short-term funds for long-term purpose. Okay, so if you find this principle useful, if you find this principle powerful, super powerful, my request is, please teach this to at least one entrepreneur you know and save his business. Because take it from me, 100% they are not taught about this. They are not taught about this. So you take the lead. Thank you so much. And with this, let's go deeper into the presentation. Current ratio already we touched on through our introduction itself. But all of you, can you just say why banks are insisting, or can you just say what is the minimum current ratio insisted at your bank level? Please type what is the minimum current ratio insisted at your bank level. Is it 1 or 1.5 or 1.33? Whatever is the ratio, please type. Yeah, I could see the ratios coming like 1.25, Sampath, Ashok 1.33. Yeah, what about others? Why banks are insisting, or what is the minimum current ratio? And why banks are insisting on a minimum current ratio of 1.33? Do you wish to know this? Why banks are insisting on a minimum current ratio of 1.33? If your answer is yes, please type BIO. BIO stands for bring it on. And take it from me, this explanation, what I'm going to give for next 2 minutes, it's a very simple, fundamental, conceptual introduction explanation, but it will make you to fall in love with financial analysis, because that's how I got carried into teaching financial analysis. Really, the logic of 1.33 impressed me so much. So I took an oath that I will go deep into financial analysis. Yes. Yeah, Mahesh is also saying it's 1.33. Now, let me just take a couple of minutes to explain why banks are insisting on a minimum current ratio of 1.33. Okay, now look at this scenario. Let's say a business is having a current asset of 100. Let's say it is 1 crore. Okay, have current assets of 1 crore and current liabilities of 75 lakhs. So in this scenario, if I calculate current ratio, what will be the ratio? Current asset is 100, that is 1 crore, and current liability is 75, which is 75 lakhs. If I calculate the current ratio, it is 1.33. Now, what we can infer out of this 1.33 is, when the current ratio is 1.33, what we can see is 75% of the current assets are funded by whom? When the current ratio is 1.33, who is funding the 75% of the current assets? Please give your answer. When the current ratio is 1.33, who is funding the 75% of current assets? You can see it on the screen. You can just type CL. If your answer is current liability, just type CL. When the current ratio is 1.33, 75% of the current assets are funded by current liability. But more than that, what is important here is, who is funding the balance? When the current ratio is 1.33, 75% of the current assets are funded by current liability, meaning remaining 25%, that is current asset minus current liability, the difference technically we call as net working capital. The remaining 25% is funded by long-term funds, right? Here, this current asset is not built exclusively with the support of current liability. This current asset of 100 is built with the support of current liability 75 and long-term funds. Technically, we call as net working capital 25. So when the bank is insisting on a current ratio of 1.33, they are actually insisting on long-term fund contribution of 25% for build-up of current asset. That is the logic. When the banks are insisting on current ratio of 1.33, it is not that they are fascinated by this number 1.33. No, 1.33 means what? There is 75% dependence on current liability for building current asset, but more than that, they are insisting the borrower to bring in 25% for building the current asset. Here I have used the number 100. So we got all this. Let's say my current asset is going to be 200. In that case, current liability will be 150 and the long-term funds will be 50. So even now, if I calculate the current ratio 200 by 150, my current ratio will be 1.33. When my current ratio is 1.33, what I'm ensuring is there is a 25% of long-term funds which have come into the system for building up of current assets. Why they are insisting a long-term fund should come in? Because that's the margin which banks are stipulating, right? If you take the sanction letter of cash credit facility, they will say borrower should maintain a margin of 25%. While when they submit the stock statement, when the drawing power is computed, 25% margin is deducted, right? To arrive at the advance value, and then only you arrive at the drawing power, right? So this 25% has a serious or a deep linkage with this current ratio. So why they are insisting 25%? Why they are insisting on 1.33? They both are interconnected. So this is the logic behind minimum current ratio of 1.33. And if you find this logic getting opened up as a bulb on moment, please comment bulb on. Simply type BO or comment bulb on if it is a real bulb on moment for you. Once again, let me summarize. When the current ratio is 1.33, the inference is there is a 25% long-term fund contribution from the borrower side for building up of current asset. And if this is a bulb on moment for you, please type bulb on or simply type BO. Simply type BO. Yes. And next, we'll talk about this. We'll talk about debt equity ratio. Why all of a sudden I'm making a jump to this? See, in financial analysis, you are analyzing the financial position, operational efficiency of the business, right? So in that, the fundamental analysis should be understanding the long-term stability of the business, whether this business is capable of withstanding recessions, whether this business has got the capacity to grow when the market is doing well. So capability to withstand recession and capability to grow in good times. And for that, one basic parameter will be looked into, that is debt to equity ratio. Bank to bank, this name will vary, or collectively it is called as TOL by TNW. That is total outside liability in the place of debt, and TNW, which is tangible net worth, in the place of equity. Now, how to understand? Let's look at this example. Just look at the balance sheet. Here, the owners have contributed 1 crore in this business, and they have taken a bank loan of 1 crore. They've raised money through debentures. They also raised some money from sundry creditors, suppliers. So altogether, they have raised around 5 crore. Of this 5 crore, how much has come from owners? From owners, what has come in is only 1 crore. And from outsiders, collectively, total outside liabilities, what has come in is 400. That is, equity is 1 crore, outside liabilities is 4 crore, 5 crore is the total funds. Now, what we do in debt equity ratio or TOL by TNW ratio is, we will be comparing this total outside liability with the owner's money to understand the long-term stability of the business. How? Look at this scenario. So actually, this is the formula. You can just take a screenshot or take a snap of it. The formula is simple. We take total outside liabilities, we compare it with the owner's money, that is shareholders' funds. And in this case, 400 is the total outsiders' money, 100 is the equity. So 400 by 100, I get value as 4, right? But how I'm going to express it, let's see. We'll do it by 3 scenario analysis. Scenario 1 to 3. Scenario 1, my total outside liability, what we discussed, is 400 and owner's money is 100. And now I can calculate the debt equity ratio by comparing these two. 400 by 100, I will get the value as 4. But since it is a ratio, I will be writing it as 4:1. I'll be writing it as 4:1. And what that communicates is this business, in this business, owners have contributed only 1 rupee and they have borrowed 4 rupees from outsiders. And with this 5 rupees only, they are running the show. So that means out of 5, outsiders have contributed how much? 4. 4 out of 5 has come from owners, which amounts to 80% of the total funds that have come into the business. And owners have contributed only 1 out of 5, which is 20%. So this business is actually more dependent on outsiders. If outsiders stop extending the support, or if outsiders start demanding the repayment, there is a possibility this business will see the heat of financial risk. What is financial risk? The risk which arises because of having too much of outsiders funds in the business. When you raise outsider funds in the business, they are not free, right? They come with a cost. They come with a repayment schedule. So whatever happened, let it rain, let sun shine, let there be recession, let there be cyclone, whatever happens, you have to pay off these guys. You have to pay interest, you have to pay principal, interest at monthly intervals, principal as per agreed terms. And if you don't pay so, they will sue you for non-payment. That's what we call as financial risk. So in scenario 1, it looks like they have high financial risk because they are 80% dependent on outsiders. So let me just change the scenario. This total 5 crore, I'm just going to change the composition. In scenario 2, I'm reducing the outside liabilities and increasing the equity. And the total is same, maintained at 5 crore. And now if I calculate the debt equity ratio, which is 333 by 167, I'll get the ratio as 2:1. And what this means, for every 1 rupee contributed by the owner, this business has borrowed 2 rupees only. So this actually looks better than scenario 1. In scenario 1, for every 1 rupee contributed, they have borrowed 4 rupees. In scenario 2, for every 1 rupee contributed by the owners, business has borrowed only 2 rupees. It means outsiders have contributed 2/3 of funds for this business, which is 67%, and owners have contributed 1/3, which is 33%. So scenario 2 looks better than scenario 1 as of now. And let me just try with one more scenario where I'll maintain the same total of 5 crore, but I'll change the composition where I'll reduce the total outside liabilities even further and increase the equity. So now if you see, they both look equal. Outside funds are 2.5 crore. Owner's money is also 2.5 crore. And now if I calculate the debt equity ratio 2.5 by 2.5, I get the ratio as 1:1. And what that means? Debt is 1 out of 2, equity, that is owner's money, is also 1 out of 2. So outsiders, they have contributed 1 out of 2, which is 50%. Owners have contributed 1 out of 2, which is also 50%. So this looks actually healthy. So in these 3 scenarios, as a banker, as an investor, if I analyze this, for me, scenario 1 will be high financial risk scenario because they are dependent on outsiders. So if any force majeure happens, they will end up in loss. They'll get into serious issues. Why? Because they are dependent more on outsiders' funds. Scenario 2 looks ideal, and scenario 3 is the best. If a business could afford for this, nothing like that. Okay. So this is about debt equity ratio. Now coming to you, what is the debt equity ratio or TOL by TNW ratio acceptable or tolerable at your bank level? Because for current ratio, we have seen ratios like 1.25, 1.33 and all, right? Similarly, for debt equity ratio, up to what level your organization, your bank will go? Is it 4:1, 5:1, 3:1, 2:1, whatever is the ratio, please comment so that we can see. Yeah, banks, they also go for 5:1. Yes. See, again, 5:1, 6. I know banks which even go up to 7:1, Again, in those cases where they go for the ratio like 7:1, for them, the convincing factor will be the profitability of that entity. They'll have repayment capacity. The businesses which operates with thin profit margin, let's say their profit margin is very thin, that business will get into a severe oscillation, severe fall if there is going to be a slight variation in their sales. because a small drop in sale will bring a significant drop in profit. Okay, so businesses which are fundamentally stable with a good profit margin, their banks will take risk. They'll go 4:1, 5:1. As you said, they even go 10:1. See, vehicle loans and all they go. Vehicle loans and all they go because in the event of default, there is going to be a simple repossession. But we are talking about business loans where the facilities are given in the form of cash credit, right? Overdraft, term loan, where the repayment is dependent on entire performance of the business. Okay, the repayment is dependent on performance of the entire business because it's this loan which is going to influence the entire business. So in that angle, especially when you deal with SME and corporate segment where the credit facilities are given at that range, even 5:1, they look at like very risky because the kind of portfolios where I handle, banks will be really afraid of touching proposals which are beyond 3:1. If it is beyond 3:1, they will say this entity is leverage. Let us not take risk. Let us not take risk. Okay, but healthy companies, cash flow rich companies, they take deviations and go. And when they take deviation, they'll have strong justifications. So this 10:1 cannot be applied across the spectrum. Okay, Uday, I hope I have answered, right? So that's about debt equity ratio, or the clear name is TOL by TNW. See, the why I'm repeatedly saying this because there are two kind of ratios here. One is debt equity ratio, the other one is TOL by TNW. TOL by TNW is used for evaluating the business as a whole, whereas debt equity ratio, some banks, they use it very specific to project. Very specific to project. Let's say you are going and purchasing a car. So the car project cost is 10 lakhs and bank is giving you 9 lakhs and you are bringing in 1 lakh. So here you are bringing 9, sorry, bank is giving you 9 and you are bringing 1. They will calculate debt to equity ratio for the project, which will be 9:1. In those cases, it's okay. That's what I think Uday also mentioned. Vehicle loans, they are going for 10:1. Their debt to equity ratio is calculated with reference to that single project only. It is debt to equity ratio of the project, not of the business. I'm talking about the ratio which is used for evaluating the business in totality. That's why instead of the word debt, I prefer using the word TOL. TOL stands for total outside liability divided by TNW, which stands for tangible net worth. Okay, adjusted tangible net worth means any investments that are made in subsidiaries, associates, sister concerns that will be subtracted from TNW, tangible net worth. That's what we call as ATNW. Okay, I hope Uday answered that as well. So that's about debt equity ratio. And now, okay, let me just skip this. And now let's get into the next critical important part of this session, that is debt service coverage ratio. Because we talked about two ratios, right? One, we talked about current ratio, which is very important for working capital assessment cases. Two, we talked about debt equity ratio, which is very important to understand the long-term stability of the business. Three, what we are going to talk about is debt service coverage ratio, DSCR. Why this ratio is important, in what context this ratio is used. This ratio is used whenever a business approaches a bank for term loan. When a business approaches a bank for term loan, a bank will be in a position to say yes or no for a loan, for a term loan, by looking at the single ratio. Because this ratio literally factors everything except the collateral security. Why? Because for bank, giving a term loan means they are investing in your business for a longer period. It is not like cash credit, overdraft. Cash credit, overdraft, they are all repayable on demand. If they see you are not complying with sanction condition, they can call back the money whenever they want. If they see there is a drop in primary security, they can call back the money. It is repayable on demand. That's how agreement is signed. But that's not the case with term loan. Term loan means they are entering into an agreement where they say that You can repay the loan over a period of 3 years or 5 years or 8 years as per agreed repayment schedule. It means they are investing for a longer period. So that decision they have to take. I mean, if they want to say yes for giving a term loan, they should see what will be this entire future term loan period, right? The bank is giving term loan. Let's say bank is giving term loan for setting up a factory, and the term loan is for a period of 8 years. They have to see for this entire 8 years what will be your sales, what will be your expenses, what will be your profit, what will be your cash profit, what is the repayment obligation, whether the cash profit will be sufficient enough to cover the repayment obligation, and whether any surplus will be left within the company so that they can use it, they can reinvest in the business for growth purpose. Everything is covered in the single ratio called DSCR. So now the time is 12:03. Are you really serious about learning DSCR? If yes, please type DSCR. Only if you're serious about it, we'll talk about this, or else we can wind up now. Okay, let me see how many answers I'm getting. Are you really serious about learning DSCR? If yes, type DSCR. Uday is serious, Sampath is serious, Venkatesh, Vijay Patel, Gopal Krishnan, Kuldeep, participants in YouTube, are you really serious about learning about DSCR? Please type DSCR. Yes, good. I got many comments. Fine. So just now I said they are going to look into your future. They are going to look into your future. In future, what will be your sale? What will be your expense? What will be your profit? What will be your cash profit? Whether the cash profit is adequate enough to cover the obligations. Okay. So in DSCR, what we are going to do? We are going to see whether cash profit is available for servicing the debt. It means for this entire period, there will be a repayment schedule, monthly payment schedule, or quarterly or bullet payment, whatever, whether your cash profit will support that or not. But now the question is, which profit will be taken into consideration? Which profit? Whether the loan can be directly paid out of sales? No, because when a business makes sales, there are several people in queue to take their share. Raw material suppliers, laborers, employees, electricity board, fuel, miscellaneous expenses, manufacturing expenses, service expenses, all people are going to take their share. So it's after paying all this, a profit will be left out. Okay. Maybe we can call that profit as EBITDA, earnings before interest, depreciation, and taxes. Whether this profit can be used for paying this principal and interest, answer is partially yes, partially no. Why? Because this profit, I said EBITDA, right? EBITDA means what? Earnings before interest, taxes, depreciation, amortization. That's what we mean by EBITDA. So this is a profit before paying taxes. You cannot ignore tax, right? So you have to take profit after tax. Why? Because in the world, in this world, if you ask what is real, tax is real. You have to pay tax, no other choice. So you have to take profit after tax, and with this profit after tax, you can pay loan. But if you ask me whether interest can be paid out of profit after tax, answer is no, because this profit after tax is itself arrived after subtracting all expenses, which also include interest, which also includes depreciation, which also include taxes. Are you all with me? Just type with you. Just type with you. Because the screen is static. I'm just talking. No animation on screen. So I just want to understand whether you're all with me. Okay, right. So what is important here is we should know what is the cash profit available for servicing the debt. It is not gross profit. It is not operating profit. It is not EBITDA. It is not profit before tax. It is not even profit after tax. What is important for servicing the loan is cash profit. Why I am insisting on the word cash profit? Because I said while arriving at the profit, we will be subtracting all expenses. we will be subtracting interest, we will be subtracting depreciation, we will be subtracting taxes, then we arrive at profit, right? But here, this particular item, one item called depreciation, absolutely there is no cash outflow. One item called depreciation, absolutely there is no cash outflow. But that is subtracted to ensure compliance with the accounting related norms and tax procedures or compliances. But there is no cash outflow. So an item is subtracted as expenses, but there is no cash outflow. So what we can do, we can nullify that subtraction by adding back. So how to understand? Let's take an example. Okay, this is the formula. I'll come back to this. Let's take an example. Look at this. This is the sales made by an entity, 1,000. For achieving the sale, they had some direct cost of 500. So you know what is your gross profit. And from this gross profit, some operational expenses are paid. So say that operational expenses are 100. And as I said, depreciation also have to be provided to comply with accounting norms, to comply with various compliances. And it is also fair to provide for depreciation, because when you are providing for depreciation, what you are doing, you are accounting for the assets that have been utilized in the business but not written as expense, because assets you will not write as expense, right? Land, building, plant and machinery, furniture or fixture, they will not come to P&L as expense, rather they will go to balance sheet as asset. And using those assets only, you are actually running the show, but they will never come as expense and sit in the P&L statement or income statement. But that is unfair. Instead of buying those assets, if you had rented those assets, you would have written a rental expense. You are not providing that. So to ensure a fair comparison only, whatever the assets that are sitting in the balance sheet, to the extent that is used in a year, a name will be given and it will be subtracted from the balance sheet asset side and it will be written as expense in the income statement or P&L statement. But friends, there will not be a single rupee outflow, cash going out in the name of depreciation. It is only a book entry, accounting entry. Okay. So from gross profit, I subtract operating expenses, I subtract depreciation, and I will also subtract the interest that is going to be paid on the term loan. You are asking for a loan, you will be paying interest on that. That is also an expense. So that will also be subtracted. So this is how a typical P&L, profit and loss account, will communicate the information. The structure and format will vary firm to firm, country to country. But what eventually it communicates is this: sales minus direct cost is your gross profit, minus operational expenses will give you operating profit. Sorry, minus operational expenses and depreciation will give you operating profit. Then this interest on loan, if you subtract, you will get to know what is the profit before tax. So in this case, profit before tax is 200. Then you have to pay taxes 100. What you get is profit after tax. Now, I want to know what is the DSCR for this business. For that, what I have to do, I have to take cash profit. I have to compare it with the repayment obligation. When I say repayment obligation, there will be interest element and a principal element. We know what is the interest element, that is 100. And principal, I am telling you upfront, that is also 100. So their repayment obligation is overall 200. Now, how they will pay this 200? Whether the 200 will be paid out of 100, if you think so, understanding is wrong. Why? Because this 100 is itself arrived after paying the interest. So this 100 is itself arrived after paying the interest. So I may be partially right in thinking this 100 will be available for repaying the principal, because interest is already factored, interest is already subtracted. But in DSCR, what we are doing is, in DSCR ratio, what we are doing is, we are looking at the cash profit available for servicing both interest and principal. But this profit will factor only principal. But I also want to measure what is the profit available for repaying interest. How I can do? Very simple. Take this profit after tax. With that, you add this interest on loan. So now I have 100 plus 100. So I have a adjusted profit of 200. With this 200, I can pay interest also. With this 200, I can pay principal also. Yes or no? Just type yes. Just type yes if you got this concept. I cannot pay interest and principal with this 100. Why? Because this 100 is already after factoring interest. But the formula says, please measure the repayment capacity for both principal and interest. So what I have to do, I have to calculate adjusted profit. So with this 100, if I add interest on loan 100, I will get adjusted profit. But formula is not okay with adjusted profit. Formula wants cash profit. Why? Because it wants all the non-cash items to be knocked off. And we know here the depreciation is a non-cash item, right? If I knock off this, it is already subtracted. So let me add it back. So if I add all the three, what I get is 300. See, the profit after tax is 100. I added interest on loan 100 for adjustment purpose. I added depreciation 100. So there is a revised profit and we call it as cash profit. This cash profit is now available for meeting the repayment obligation, which I already said, which is 100 plus 100, 200. So now I can use this cash profit. How I calculated this? I took profit after tax and I added depreciation and interest. Okay. So in the numerator will be, I think, yeah, interest is sitting over here. The numerator is profit after tax before depreciation and interest. I repeat, profit after tax before depreciation and interest. That's what we did, right? We took profit after tax, we added depreciation, we added interest. That gone to the numerator. And what is denominator? Denominator is my repayment obligation. My repayment obligations are 100 plus 100, which is 200. So let me calculate 300 by 200, and what I get is 1.5 times. What I get is 1.5 times. So if I express this as ratio, it will be 1.5:1. And what does that mean? For paying 1 rupee, this business is making a cash profit of 1 rupee 50 paise. It means they are comfortable. Why? They want to pay 1 rupee. They are having a cash profit of 1 rupee 50 paise. So there is a surplus of 50 paise. And why this surplus is necessary? Because this surplus can be reinvested in the business. See, a business cannot be run with the sole objective of repaying the loan alone, right? I mean, a business cannot be happy or complacent if their cash profit is 1 rupee and their repayment obligation is also 1 rupee. What does that mean? It means that entrepreneur is not going to take anything home. He earned 1 rupee, is paying 1 rupee. That's not the objective, right? So his earnings should be, his cash profits should be much higher, much higher. See, it is not EBITDA. Uday, this is not EBITDA, because EBITDA is earnings before interest and taxes also. But look at the formula. It is earnings after tax, but before depreciation and interest. EBITDA does not factor tax. But tax is real. You have to provide for tax. That's why we altered the formula. We took earnings after tax, but before depreciation and interest, so that we can measure what is the cash profit available for repaying the loan. And here it is 1.5 times. Okay. So this is the logic behind DSCR. And at your organization level, at your bank level, what is the minimum DSCR insisted? Here we have worked out 1.5 times. Can all of you answer what is the minimum DSCR insisted at your bank or organization level? Is it 1.5 or is it 1.25 or 1.75? Whatever is the ratio, please comment. What is the minimum DSCR? Okay, Uday is saying it is 1.75. What about others? Please participate. For you, it's a matter of just typing. What is the minimum DSCR? Venkatesh is saying it is 1.33. Okay. Sampath is saying 1.25. Okay. See, sometimes some banks will be very particular. They'll insist on a higher ratio, say like Uday's bank. Uday Bank is insisting on a 1.75 ratio. There is a logic behind that. So that logic you will be able to extrapolate even for 1.33, 1.25 also. So are you really interested in learning or understanding the logic behind why DSCR of 1.75 is insisted, so that knowledge you can extend for your level like 1.33, 1.25. If you're really serious, please type BIO. BIO stands for bring it on. BIO stands for bring it on. Yes, Sampath? Okay, how about others? Are you really serious? Yes. Gopal Krishnan, Uday, Venkatesh. Okay, fine. Without much delay, let me take you through. See, when the ratio is 1.75, we write it as, or we infer it as 1.75:1. What does that mean? There is 1 rupee 75 paise cash profit for every 1 rupee obligation. It means out of 1 rupee 75 paise, 1 rupee can be paid for the bank loan principal plus interest. It means 75 paise is left within the business. So this 75 paise can be retained within the business, and this can be reinvested in the business. So when the 75 paise is retained within the business, it will be available in the form of profit after tax, and it will go to retained profit. This retained profit will eventually go to the balance sheet under the heading reserves and surplus. So when it goes to reserves and surplus, that will eventually get merged under the heading called equity. And this equity is basically a long-term fund, Now, why this understanding is important? Do you recollect the logic behind minimum current ratio of 1.33? What is the logic behind minimum current ratio of 1.33? When the current ratio is 1.33, it means there is a 25% long-term fund build-up for the business. From where the long-term fund will come? The long-term fund can come from owners directly as capital, indirectly by retaining the profits within the business. And it can also come by raising some long-term loans, loan from family, friends, relatives, all those, right? So long-term funds can come from owners directly as capital, indirectly by retaining the profit, and the third is from outside sources. So here, when the DSCR is insisted at 1.75, 0.75 is retained within the business, which is helping for the buildup of long-term funds. When there is a buildup of long-term funds, it will support the current asset. When current asset is funded through long-term funds, there will be liquidity comfort in the business. When there is liquidity comfort, there is going to be really a peace of mind. When there is a peace of mind, that business, that entrepreneur will be able to concentrate more efficiently towards the business. Let me try to put this in a diagrammatic form. So here, look at this. When the DSCR is 1.75, 1 rupee is paid, 75 paise is retained within the business. And when it is retained within the business, eventually the retained profit will be taken to balance sheet, right? So where it will go to balance sheet, in balance sheet, this will go to a head called reserves and surplus. This 75 paise per obligation will go towards reserves and surplus. This reserves and surplus, along with capital, collectively we call it as what? Equity. This equity, along with long-term liabilities, collectively we call it as what? Long-term funds. This long-term funds will contribute for build-up of long-term assets. Not only long-term assets, it will also contribute for build-up of short-term assets. We know short-term assets will be funded by short-term liability, agreed. But long-term funds can also, because in fund utilization principle also I stressed, right? Long-term funds can be used for supporting short-term assets also. And long-term funds can come from owners directly, indirectly through long-term sources. So look at here. What is retained because of this DSCR level is sitting in long-term funds, and it is helping the buildup of long-term assets, and the balance is helping for buildup of short-term assets as well. And it's because of this reason, the premise, the logic behind 1.75 is this, that is to help the business to build up their current assets with long-term funds so that their margin will be high. When their margin will be, when their margin is high, their dependence on current liabilities will come down. When the dependence on current liability comes down, automatically the liquidity pressure in the business will be lesser. When the pressure is less, focus will be more. When the focus is more, the business will perform better. So this is the logic. And how many of you find this logic as a bulb on moment? If it is a bulb on moment for you, please type bulb on. You can also comment bulb on if you're deriving value from the session, if you have learned something critical, meaningful, sensible, something important for your job, something important for your career. Please type bulb on or simply type BO. I see your bulb on comments. I see your bulb on comments as the value you are deriving from this webinar. Yes. See, why only 0.75? That depends on the risk aptitude of the banks. We have seen some banks are insisting on 1.75. Some are okay with 1.3. Some are okay with 1.5. So that depends on the risk-taking capability of each and every bank. Conservative banks, they'll say 1.75 because the remaining 75, let it get reinvested in the business. Let it get reinvested in the business, so business will remain healthy. Okay, that's the objective. So how many of you find this as bulb on moment? If it is a bulb on moment for you, please type bulb on or simply type BO. And how many of you are really interested in continuing this learning further? Because what you have seen now is only tip of the iceberg. Yes, I mean it. What you have seen now is only tip of the iceberg, because when you are in credit profile or when you are a finance executive or professional, the knowledge what is required is much more, and it is not necessary for that you should undergo 3 or 4 years of academic program. No, what I've shown you is tip of the iceberg, but in reality, let's say as per your profile, maybe you have to read balance sheet line by line to take critical decisions. You may have to analyze various ratios. We just talked about 2 or 3 ratios. You may have to analyze various ratios. You may have to do in-depth cash flow statement analysis, fund flow statement analysis. Then you may have to develop special skill for assessing the working capital, term loan. You should be able to prepare something known as CMA report. Then when it comes to term loan project financing, there will be many technical analysis areas. DSCR we just touched on. There are break-even, sensitivity analysis, techno-economic viability, and how to arrive at credit risk rating. And you should also be able to come across customers from different business models, different profiles. You should also have knowledge how the forex fluctuations is going to have impact on all this. And if you want to master all this, if you want to learn all this, if you want to continue this learning, please type ILM. ILM, which stands for I am interested in learning more. If you are interested in learning, if you are interested in continuing this journey further, please type ILM. What I have given in this 60 minutes is a tip of iceberg. I mean it. I mean it. Okay. Yes. So yes, I could see a few of you are interested. So do I have your permission to introduce the course which I have designed to teach this comprehensively? What you have seen today is a sample, is a demo, is a tip of the iceberg. Do I have your permission to introduce my course, which I have designed exclusively for learning this? If you're permitting me, please type yes. I need your permission so that I can introduce the course. If you're permitting me, please type yes. Yes, thanks for the permission. Yes, here we go. We have a course called Financial and Credit Analysis Mastery. The name will be interchanged like Credit and Financial Analysis Mastery or Financial and Credit Analysis Mastery, whichever it's same. So what this course is, this is a course which comes with 15 modules of video lectures. Okay, 15 modules of video lectures and several ebooks. Let me take you through one by one. Module 1, the price is around 1,499. This module will take you through the basics of credit analysis. See, when you are doing credit appraisal, there are certain fundamental knowledge you need. So that is covered. It's a fundamental course, which is part of the package. Then there is a second course called How to Read Balance Sheet. In this course, we have introduced the concept of balance sheet through simple examples. We have given bird's eye view of financial statements, and we have used a few real life financial statements to help you to get a grip of reading balance sheet. This is module 2. Then there is module 3. Okay, so these are all 8 sections in module 2. Totally, we have 10 sections. And if you see, we have also used some big balance sheets to analyze the scenarios. And then comes module 3, which deals exclusively with financial ratio analysis. Here we talked about 3 ratios, right? In this course, we would have covered all the ratios. Then comes module 4, where we would have used a cash flow statement and we have analyzed a cash flow position. So by going through this module, you will get master knowledge in reading and analyzing the cash flow statements. Then comes module 5, which deals with fund flow analysis. This is a powerful financial analysis tool, which actually helps the sanctioning authorities to take a decision to not to give a loan. There are certain cases where the borrowers may not be eligible for a loan. but they will present all the fancy picture. But all those masks will be removed by a simple analytical tool called fund flow statement, and that is explained through this course called fund flow analysis. So far, I have introduced or shown you 5 courses, each 1,499. So the overall price is around 7,495, but I'm not going to charge you that money. I'm going to give this 5 course for 1 year access at rupees 2,499 or lifetime access at rupees 4,999. Not yet over. I told you, no, you have lot many bonus here. I'm also going to give you access to a course called How to Carry Out Credit Risk Rating. This is for non-trading entities. Similarly, there is a course on how to carry out credit risk rating, which is for trading entities. So you are getting 2 additional courses, again priced at the same level. Then there is a comprehensive course which will run for 8.5 hours, how to prepare CMA report for bank loan. It's a comprehensive course. And in this course, you will learn the entire process of preparing the CMA report. So how many courses now? So far, 5 plus 3, 8 courses. And there is a course on how to prepare cash budget. This course will come handy when you are going to give loan on ad hoc basis. Let's say you are giving the loan for 30 days, 60 days, 90 days. Then you should know when that loan will be repaid, the exit, how it will happen, how the cash flows are going to come. All will be understood, or we can understand them through cash budget. So that course is also included. So these are all the contents of the course. And I'm also going to give you one more course, how to assess fund-based working capital. That is cash credit overdraft. So there are a lot many concepts behind the cash credit and overdraft assessment. So you should know those concepts. You should know what is working capital cycle, operating cycle. You should know holding levels. There are various ratios connected with that. And you should know how to assess the limits. Let it be Nayak committee or Tandon committee or assessed bank finance method. All those are covered in this single course. So this is course number 10. And you will also learn about export finance as well. So there are totally 10 courses. The price is 1,499 into 10, approx 15,000 or 14,990. But I'm going to offer it to you for 1 year access, the same price of 2,499 or lifetime access price of 4,299. You can choose as per your requirement. Not yet over. I'm also going to give you some more courses. Course number 11, how to assess non-fund-based facility, like letter of credit, bank guarantee, how the assessment happens. That is explained in the course. Number 12, this is a comprehensive course on term loan. How term loan assessment, appraisal assessment is done. What is TEV? How to arrive at cost of project means of finance. How to analyze the production factors of a project. How to do the technical analysis in term loan appraisal. All covered. So course number 12 done. Course number 13, this will give you the basic elements of loan proposal. Like when you write the loan proposals, what are the basic elements you should have clarity about. That is covered in this course. Then comes course 14. This course is exclusive of credit analysis, financial analysis, case studies, practical cases, which we got to know by discussion with our students, bankers, experts, and cases picked up from various study materials, all covered in this particular course. And then comes course number 15, which is a supplementary material where you will get a idea about collateral securities. Okay, so overall, we talked about 15 courses, and 15 courses, the price range should be of how much? What should be the price range? 15, 1,499 into 15, it's around 22,485. You will get access to more than 1,000 lectures in these courses. All these are pre-recorded course. You can actually access them in your mobile by installing our learning app. You can access them in your desktop, laptop. This is the overall price. But if you are joining now, you can join for 1 year access at rupees 2,499 or lifetime access at rupees 499, 4,999. And not yet over, friends. Some more. You have some more bonus. I told you, there are a lot many e-resources. There are several e-resources in this course. You will get access to this 5 ebooks related to financial ratios. You'll get access to ebooks, almost say 7 ebooks related to financial management. That is very important. And you will get access to financial analysis related ebooks. You will get access to credit analysis related ebooks. Not yet over. You will also get access to test series where you can test your knowledge, whatever you have learned through these courses. I'm also going to give you a CMA template. You will get access to one audio book, you will get access to one video book, and you will get one career guidance material and something, this is final, not connected with the topic, but a child future education planning financial template. Like if you want to put your child in college after 5 years, 10 years, how you should plan for how much fund you should set aside every month, allocate every month. Okay. So all this. So let me just summarize. It's 15 courses, video-based courses, 1,000 plus lectures, 22,485 rupees worth. Then 25 ebooks and e-resources. This is the approximate value we have placed. You can place higher. And you are going to get lifetime access. If you're going for 4,999, you will get 1 year access. If you're going for 2,499, these are all pre-recorded courses, so you can access them anytime as per your convenience, accessible in mobile app and desktop. Overall, the value is around 25,000, but for 1 year, you can enroll for rupees 2,499, or lifetime, you can enroll for rupees 4,999. So whoever wants to continue this learning journey, make use of this opportunity. If finance is a constraint, go for 1 year access. If you want to be a lifelong learner, if you want to apply this knowledge, let me tell you, this course will come with you lifelong career in your banking. So if you want to be a lifelong learner, go for lifetime access, or you can go for 1 year access. I'm going to place the link now. So just give me a moment, and whoever interested in continuing this learning journey, whoever interested in continuing this learning journey, whoever wants to join now, please type IME. IME stands for I am interested in learning. IME stands for I'm interested in learning. Please type IME, and I'll stay back for next 15 minutes, and whoever completes their enrollment, I'll be giving my live acknowledgement. Okay. So now I'm placing the 1 year access link. This link is for 1 year access. And I think there is a possibility when you click the 1 year link, it may show. Yeah, it's working. No problem. If any of you face an error, let me know. Because in the link, there are supposed to be 2 hyphens, but now I see as a single hyphen. And I'm also giving you the link for lifetime access. Okay, this is the second link is for lifetime access, the recent one, or let me place it combinedly. Lifetime access. Okay, so there is a lifetime access link and 1 year access link. So whoever enrolling now, please type IME. I'll stay back. I'll stay back and I'll give you acknowledgement. And probably when you go to this particular page, when you click the link, go to the page, you may see a pop-up asking you whether you want any discount. Please ignore that, because already I have applied the discount and I have given the link. So do not fill any form or any pop-up that comes up. You can directly go ahead with the enrollment. And I'm also placing the link here for the benefit of YouTube participants. If the link is not clickable, if the link is showing any 404 error page, please let me know. For YouTube participants, I have shared 1 year link. And I'm also sharing the lifetime access link. And once you complete the enrollment, let me know. Once you complete the enrollment, let me know. And probably when you go to this page, okay, 1 year access is showing error. Okay, just a moment. Yeah, I have given revised link for 1 year access. Please try. 1 year access. If any of you are facing issue in 1 year access link. I'm giving the revised link. Anyone facing issue with lifetime access link? If any of you are facing issue with lifetime access link, please let me know. In YouTube also, I have placed the revised link for 1 year access. Any of you are going for lifetime access, and if you are facing issue, please let me know. And I'm giving the revised link for lifetime access. If any of you have completed, let me know. This link may remain active for another 20 minutes. So whoever wants to take advantage of this, make use of this link, and we'll catch up next Sunday with a similar webinar. Thank you all.